Good evening, class, and welcome to our performance management class for today. Our topic is Introduction to Capital Budgeting. So we'll be looking at budgeting, but this time not budgeting as in the case of the one we did in variance analysis where we budget production and production, yes. This time around, we are looking at capital, how we budget capital. We'll be looking at capital expenditure, investment appraisal, and capital budgeting. They'll be looking at something called the accounting rate of return method, then the payback method of capital investment appraisal. So let's dive into our topic for today. Capital expenditure. Capital expenditure is spending on non-current assets such as buildings and equipment, or when you invest in a new business. So it means that when you buy shares, when you put in capital into the business, you bought the assets, you provide the funds that is required to start a business. What do we call that? Capital. And so it qualifies as a capital expenditure. As a result of capital expenditure, a new non-current asset appears on the statement of financial position, which is called the balance sheet. Let's take, for example, the owner decided to inject maybe 10 million naira in form of bank transfer. Now, that bank transfer is a cash at bank. That is going to be in the asset side. Of course, that is not a non-current asset, it's a current asset. But one thing is that there is also going to be a corresponding entry in the capital side. Now, after spending that cash, he decided to bring in vehicles. Now, that vehicle is a non-current asset. It will appear in the balance sheet as a non-current asset. Also, it will be in your capital. So anything that the owner or the investors of the business are putting into the business are called capital. And so when you invest in things like this, it is called capital expenditure. In contrast, revenue expenditure refers to expenditure that do not create long-term assets, but is either written off as an expense in the income statement in a period, and it creates a short-term cash, short-term asset. For example, when you purchase an item of inventory. So there is a difference between item of inventory, which is a purchase, we call it strictly purchase, not we will not call it inventory. This we'll call it inventory, yes, but we'll also refer to when we buy them as purchase. Then when you purchase something that is not inventory, then it is called acquired. Take for example, someone might be dealing with furniture, and when he buys wood, that is purchase. But if he goes and buy vehicle for official use, that is acquired. That's assets. Now, someone who is into car business, when he buys cars for resale, now that is not acquire, that is purchase because that is inventory. But if he buys, even if it is that same type of car, but for office use, that is a capital expenditure. So it is not the kind of asset, it's the kind of business and what is revenue for them. Anything that is generating sales for them where you are selling off and you are making revenue. When you buy them, it is purchase of inventory. Capital expenditure initiatives are often referred to as investment projects. So it means that when you are initiating a capital expenditure, you are investing in a project, be it building of house, be it purchasing of a house, or be it acquiring of vehicles, you are having an investment project or capital project. They can involve just a small amount of spending, depend on the business, but many times it is large amount of money that is involved. Now let's look at the distinction that is possibly made here. Is essentially capital spending, essential capital spending to replace worn out assets and maintain operational capability. So your car is dilapidated, it is worn out, you replace them so that your car will be able to carry you to make your deliveries. So that is, I would now say maybe this is delivery van. Okay, let's use delivery van so that you can maintain your operational capability. It could also be a machine. Maybe you are a baker and your machine is worn out, it is occasionally malfunctioning, and you are now replacing it so that you can meet your customers' demand. Remember when we were doing um, divisional performance, we also use something about capital expenditure. Now, we also have discretionary capital expenditure on new business initiatives that are intended to develop the business, make a suitable financial return on the investment. So now, in this, we are going to be focusing on this second one, which is discretionary capital expenditure. You want to pump in money so that the business will be able to make some returns. Now, you are not just replacing your existing assets because they are worn out, you are now making business projects so that you want to earn financial return. Now, let's look at investment appraisal. When we say investment appraisal, we know that before any capital expenditure project is to be undertaken, they need to be assessed and evaluated whether it is feasible, whether it is doable, whether it is worthwhile. It's just like saying that you are living in Lagos and you got a job in Abuja. Okay, let's say you're living in Abuja and you got a job in Lagos where the job will be paying you say 200,000, and your transportation to and fro for the work, maybe you're working Mondays to Saturdays, you will spend 100,000 and you end up going home with 100,000. And you are in Abuja and you got a job of 150,000 and your transportation is just 20,000 or even 30,000. You find out that even if it is 30,000 or maybe 20,000, you go to work Mondays to Fridays. You have extra days to rest and you are not spending much. Your take home pay now becomes 130 compared to Lagos, where you are earning 200, you're going to work Monday to Saturday, and your take home is 100. Which will you do? Will you say, oh, I'm looking at the money that I'm going to make, and they are not looking at the risk, they're not looking at the downside? And now you need to look at it. Is it doable? Is it feasible? Investment appraisal also does the same thing. As a general rule, projects should not be undertaken unless this project will provide suitable financial returns. Like the one I said before, if you are going to look for a job whereby the salary, the take home pay after your normal expenses to get your salary, like your transportation, is not able to make you save and you end up borrowing at the end of the month, even after getting paid, it is not a suitable return. Or even if it is suitable return, you end up, it enable you to save more. Maybe the first job you are evaluating is able to make you save 50,000 naira every month. You see a second job, it's enable you to save 70,000 every month. You see a third one, it's enable you to save 80. You see that you go for the one that enables you to save more. Suitable financial return. And you should not accept it if the investment, unless the investment risk is acceptable. Investment appraisal is the evaluation of projects of a capital nature so that you can make a decision. Now let's look at capital budgeting. Now, what's the difference between investment appraisal and capital budgeting? Now, investment appraisal here, you are saying that should I undertake this project or not? Should I do this project? Is it worthwhile? Will I make a financial return on it or not? Now, capital budgeting. Capital expenditure by a company should provide long-term financial return and should therefore be consistent with the company's long-term corporate financial objective. Therefore, company capital expenditure should be made with the intention of implementing it. Now, many companies may have a capital budget and a capital expenditure should be within the spending limit of the company. For example, if your capital expenditure or your capital budget for the next 10 years is 10 million naira, but your capital expenditure happens to be 15 million, that means it is not within your spending limit. So it means that you need to take your capital expenditure within the spending limit of your capital. Now, what if you want to you want to make one or two capital expenditure, and you said you have a capital expenditure budget of 10 million, and maybe you have five expenditures to make, each of them costing you 3 million. Of course, you won't spend them on all the five because it will be beyond your budget. So it means you must budget and see which one you will do. And that means I'm talking somehow in the neighborhood of what did we learn the other time? Limiting factor. So something has limited your budget. Now, with long-term capital budgets, there should be more detailed spending plans, excuse me, for the next year or two. For example, individual capital budget that are sorry, that are formally approved should be included within the capital budget. New ideas for capital projects, if they satisfy the investment appraisal criteria, are expected to provide financial returns. They will need to be included in the capital budget. Now, what it means here is this. You first of all make an investment appraisal, and if it is worthwhile, satisfactory to the company with the intent of implementation, it is thrown into the budget. Now, in the budget, which one is then implemented? It will now be what the budget can carry. And there are techniques you will need to know how to take which one the company would carry when there are limited funds. So that means the limiting factor here is the budget. Investment appraisal and capital budget. Investment appraisal therefore takes place within the framework of capital budgeting and strategic planning. It involves generating capital investment proposal in line with the company's objective, forecasting relevant cash flow. So that's the next thing we're going to be doing. So we'll look at it will be in line with the company's strategic objective. Strategic objective that means where is it taking the company to? Is it increasing the company's income? Is it increasing the market share of the company? Is it increasing the size of the company? Is it creating more awareness? Strategic objectives. Now, we will also need to forecast the relevant cash flow. Now, your forecast is going to be top notch because you'll be relying on this forecast to see whether this project is worthwhile. So that means you must need to learn good forecasting techniques that will help you to forecast well. Then you will evaluate your project based on the relevant cash flows it is coming and other techniques. Then you will implement project which satisfies the company's criteria for deciding whether the project will earn a satisfactory return. That is the investment appraisal. Then you will then monitor the performance of the investments to ensure that they are in line with the company's expectation. And so when you are monitoring it, you are going to be looking at are there variances? If there are variances month to month, you see what you do to control, bring them back in line. And so you see here, this topic kind of embraces other topics. Features of investment projects. Many investment projects have the following characteristics. One, project involves the purchase of an asset with an expected life of several years and involves the payment of large sum of money at the beginning of the project. So because you're going to be buying them at the beginning. Now, of course, we know that we can do hire purchase, but now in the course of this, we are not talking about hire purchase. We are looking at a lump sum payment at the beginning of the project. So it means that the returns on investment consist largely of net income from additional profits over the life of the project. So it means that you are making this investment, the company was already bringing returns for you, but because you have pumped in more money for a project, you will be getting additional profit because of that thing that you've put into the business over the life of the project. That is one thing we're going to consider. Secondly, the assets might also have a disposal value at the end of the useful life. So, when we look at the beginning investment and the ending investment is the residual value, what we put in the beginning versus what we take out at the end. You minus them, the difference is the depreciable amount. So you might have a residual value, you might not have. And thirdly, a project, a capital project might also need investment in working capital. What are working capital? Working capital, we'll still learn about working capital management. It involves the current assets and the non-current assets. In fact, it involves three out of this, which means it is involving cash, involving stock, it involves um, receivables, that's for the current assets, Then for the current liability, it involves the current payables. So they need to also invest in working capital. Cash is cash, so, but you need to invest in stock, you need to invest in payables and receivables. Alternatively, a capital investment project might involve the purchase of another business or setting up of a new business venture. This will involve initial capital and some future returns. So these are some of the ways that capital investment might be. Now look at the method of appraising this investment. There are four methods of evaluating a proposed capital expenditure projects. Now these methods are accounting rate of return, payback method, discounted cash flow methods, which are lumped into two: net present value and the internal rate of return. Now, each method considers a different financial aspect of the proposed investment. Each method, you see them, what it's their focus. Now, let's look at them. The basis for making an investment decision. When we are deciding whether to make a capital investment or not, management must decide on a basis for making that decision. So, for example, when you make a decision and somebody says, why did you take that decision? On what basis did you take that decision? You should be able to explain that basis, what you based your decision on. You can't just say, I feel like. No, I feel like. Feeling is not a basis. Or I just, or somebody will just say nothing. There is nothing that you do the with nothing as your reason. So there must be a basis. Okay, the decision to invest or not will be made mainly for financial reasons. This is the main thing that we use in making decisions. Most times, sometimes when I want to make a decision on certain things, it is financial reasons. Take, for example, investment into, let's say, I'm using myself an example now, making an investment in getting a Zoom license. It's a capital investment because uh, kind of, but some might see it as a short-term investment. But you use it for many years. Am I making returns? What use can I put it into? Apart from using it for class, can I make other use for it? So now I'm looking at financial reasons why I am making these decisions. You want to buy a car and you decide that, okay, I'm not going to buy a flashy car. I'm going to buy a business-like car. What are you going to use it for? Financial reasons. Maybe you want to put it, you want to lend it out for companies to use as rent. Maybe you also take it as Uber, also use it as delivery truck. Financial reasons. And you are now looking at what are you going to get in return. But don't forget, there could be other non-financial considerations that could be affecting your decisions. So sometimes we might think that, yes, it is cheaper buying, let's say you want to buy a particular product and you say, oh, it is cheaper to buy this product. You make more profits because it will reduce your cost when you buy it cheaper. But the one that you are buying that is costlier, maybe the lifespan or the shelf life might be longer than the other one that is cheaper. And maybe it's the one that is cheaper, if you don't sell it in good time, it might spoil in time. Might now look at, okay, this is a non-financial consideration, spoilage. They're not looking, okay, now some of these non-financial considerations might have an impact in the financial reasons. So while you are considering finance first, don't ignore the non-financial considerations. All right. So what are some of the different reasons that you may want to consider? One, the effect the investment will have on the accounting return on capital employed. You remember when we were doing ROI, we said it's controllable profit all over the investment, average investment. This is the same kind of thing. What is the return on the capital employed? So if we are using that as our basis, as our reason, then that means we are looking at something called the ARR or the ROI. So you see now, we have come back to that thing that we learned when we are using divisional performance. ARR and ROI are the same thing. When we are also going to look at ratio analysis, you are going to be saying that ROI and ROCE are also similar. Now, another reason for making a decision could be that the time it will take you to recover the capital that you invested into the business, that initial outlay that you put into the business, that head seed money, that capital expenditure, how long will it take you to recover it? Because every money you get out after you invest in the business goes into recovery. Let's say you took a loan. Let's say you took a loan, and you know the banks will tell you that they will have a create a sweeping account for you, and whatever you get from that investment you are doing or the business you are doing must be put into that account, and they will sweep it at the end of the month. So you will be asking yourself, is it how I will continue? How long will it take me to pay back this capital, recover this capital? So if that is your problem, that is your reason, then the payback period might be the basis for your investment. Because after you've paid back, any money after that is yours. Then you might be thinking, what is the expected returns for the project? Now, this time around, I didn't take money, I didn't borrow money. I'm not looking at just the accounting rate of return. I am trying to look at it now. If I'm going to discount it, meaning that what it means here is that if I decide not to put my money in this investment and I decide that I want to do it next year or next 2 years, how much of that investment, what will that investment be in the future time? Or you can even say, okay, what if I put it in a fixed deposit and they are going to be giving me money for the time I fixed that money? How much am I getting? Huh. Now you're now talking about discounted cash flow. It means that if I am deciding to, okay, now let's say Zoom license. Now let's assume that Zoom license is a capital expenditure. If I decide to buy for 5 years, as at today, how much is dollar now? Let's say dollar is 1,670, or let's just say 1,600, just to be off. Now, if I buy it today and I buy for 5 years, in the fifth year, what is the dollar amount that I would have spent buying it then? Because time value of money, money will have appreciated. $1 today is not the same $1 tomorrow. because of discounting factor. So we're going to be looking at two different ways of doing discounting factor, which is the net present value, which means a present value is given to expected future benefits. So it means that your value of 1 naira today, if you are to get the equivalent of the benefit today, next year, how much will it be? Okay, some people were saying that when minimum wage was 30,000 naira, right? 30,000 naira, and we were able to buy a bag of rice, um, about 18,000 naira. That was then. Now, the time value of money right now, minimum wage of 30,000 cannot buy a bag of rice. And now minimum wage of 70,000 cannot buy a bag of rice if a bag of rice is about 95,000. So what is a ratio of your take home pay versus the bag of rice? Now let's say that um, you bought the bag of rice. Let's look at it now. You bought a bag of rice 18,000 when your minimum wage was 30,000. That means 60% of your money was buying a bag of rice. All right? 60% is buying a bag of rice. Now, if a bag of rice is 95,000 right now, if this 95,000 should still remain 60% of your minimum wage, how much should your minimum wage be? I'll just simply divide by 0.6, meaning that you should be earning 158,333.333, because if I multiply this by 0.6, I am going to get my 95,000, which should be able to buy a bag of rice. So it means that the 30,000 naira worth during 2013-2014 is the future benefit now is about 155,000 or 158,000. So you see, that is what the kind of things we are talking about. So it means that somebody who is earning what do they call it now, 70,000 naira now, is earning lesser than somebody who was earning 30,000 then. And I saw that the NYSC people that were earning 30,000 were like, how they wish that they were the ones earning 70,000 naira now. But it is of looking at time value of money, they earn better when it was 30,000, until when the economy became like this, that 30,000, it's just the immediate people that just finished earning 30,000 that should be crying foul because things have gone up. So that is the time value of money. So we're looking at net present value, meaning that what you invest now, 1 million naira today, all your future values that you are going to be getting, you are going to be converting them to today's value. If you convert the earnings in the life of the assets to today's value, and you now say, okay, all your earnings minus the investment you make now, if the value is greater than zero, then it has added value to you, meaning that all your investment was not in vain because your net present value was a positive one. So it means that uh, you bought an asset, uh, 30,000, let's say, in 2012, and you are earning, and the value is 30,000 now, then, and you are earning future benefits, and now you are earning 95,000 naira now or 100,000 from it, and when you convert it to the benefit equivalent to 2012, it is less, everything is less than that 30,000. Then it means that you have not gotten the value for the money. So it's not just the numbers, but the value. Then we talk about the internal rate of returns. With this approach, the expected returns on an investment over the life of a project is calculated and compared with the minimum required investment. The project should be able to give you a returns that exceeds the required return. What I usually say is that the internal rate of return approach, internal rate of return is that break even rate that will make your NPV to be equal to zero. So whatever makes your NPV equals to zero, it's your internal rate of return. So anything above, any returns above that internal rate of returns, then it means that your business is doing something good. All right, so let's proceed and dive into the methods. Now let's looking at accounting rate of returns. What is it? And what is the decision rule that will make us appraise it under this method? Now, the accounting rate of return of an investment project is the accounting profit before tax. So that profit before tax is the profit you are taking, profit before interest and tax. Now you are going to be looking at it as a percentage of the capital invested. I told you before it is similar to returns on capital investment, which is ROCE. So what it means is that if I give you 500,000 naira as a capital employed and you made 50,000 as your profit before interest and tax. So the profit before interest of tax, which is 50,000, that's what you'll be doing here. You now say 50,000 divided by 500,000, which is the capital employed, which is 0.1 multiplied by 100, which means your the accounting rate of return is 10%. That is what it means here. Now, the essential feature of ARR is that it is based on accounting profits and the accounting value of the assets employed. What it means is that you are taking your accounting profits, you are also taking the asset value of the company. So it could be the net book value of the assets or the revalued assets, revalued value. It could be so. Anything that is accounting in nature. So it means that you can go back to your FA or your FRO and see what those are. Now, the decision rule for capital investment using ARO is that the capital project meets the criteria for approval if its expected ARO is higher than the minimum target ARO or the minimum acceptable ARR. So it means that let's say a company have what they call cost of capital. You see, you hear the word cost of capital. That is what it costs them. Let's say it costs them 10,000, 10%. If it costs them 10% and you are giving me a returns of 10%, so it means that If it costs me 10% to invest, my minimum should be 10%. You can't give me anything less. If you are giving me 10% back, that means I have just broken even. I've wasted my time getting nothing. So you are expected to give me something higher than 10% if that is the minimum for the company. So it means that any project using ARR that falls short of that minimum returns should not be accepted. It should not be thrown into the budget. Definition of ARR. If accounting rate of return is used to decide whether or not to make a capital investment, we calculate the expected annual accounting return over the life of the project. Over the life of the project. So expected annual return. The financial return will vary from one year to the other. So what we do here is we'll calculate an average annual returns. So what we expect to get in year one might be different from what we are getting in year two, different from what we get in year three. And so what we just do, we add everything up and divide by the number of years. Just a moment, please. All right, so if the project exceeds if the ARR exceeds the target accounting return, then the project will be taken. If its ARR is less than the minimum, the project should be rejected. Now, unfortunately, a standard definition of accounting rate of return does not exist because we have two that we can use. One of them is average annual profit over average investment. Now, what it means is this: you have 5 years that the investment is going to last. Take all the profit, that's the profit before interest and tax. That is what I mean. Take the profit from year one, year two, year three, year four, year five, add them up, get the average. Then bring the investment at the beginning, which is how much you are spending, and the end, how much is the asset worth at the end, which is like the residual value. You bring the beginning plus the end, add them together and divide by 2. Remember, we did something like that in ROI. That is what we are doing. So this is purely ROI. That's number one. Number two, it could be average annual profit as a percentage of the investment at the beginning of the initial investment. So it means year zero, which is now, the amount you spend now will be the denominator. No average of beginning and end. You bring the profits you make every year, you find the average, and you do it over the investment. Now, you will be told which one to apply. But if you are not told and you see beginning and end, use average. If you don't see end of the investment, then use the initial. So that's what I will tell you. All right, so let's look at an example. Now, should the company undertake this project? That is what is staring at us right in the face. So what we have here is companies undertaking a project which requires an investment of 120,000 in machinery. The machinery will last for 4 years, after which it will have a scrap value of 20,000. The investment in addition, the investment in additional working capital will be 15,000. So it means 15,000 is also going to be inclusive. We said when you are buying these things, you still need to, get the initial working capital additional. Now, the expected annual profit before depreciation. Remember, we did something like this. This is the profit before depreciation, interest, and tax. Is this. And the company requires a minimum of 15% from project of this type. And now ARR is measured as an average profit, annual profit as a percentage of the average investment. So now average investment is uh, is said here. Average investment. Average investment. So what should you do? What should you do now? So you will say ARR will be average annual profit all over, because they've told you average investment. They told you average investment. So you will say all over. Let me take this thing down. Average investment. All right. So now we'll first of all find what is the average profit. What is the average annual profit? So let me call it here. Okay, we'll say times 100 over or times 100%. So I will say average annual profit is just 45, 45, 45, 45. Okay, 45. These are before depreciation. Okay, so we need to first of all do the depreciation. We need to do depreciation first. We'll say annual depreciation. Annual depreciation is going to be initial minus, okay, initial investment minus scrap value all over number of useful life. Why is my line like this? All over number of useful life. Okay, so when that is being said, we say now initial value is how much here? We have 120. 120. This is 120,000 minus 20. Coming? Yes. I wanted to see if the working capital was included here. Minus 20. Minus 20. How many years is the asset going to be used? 4 years. So you divide by 4. So this is going to be like 100 over 4. But just a moment. Now, did you see here that this is 100? Now, from year 1 to year 4, how many? There's 45, 45, 40. Okay. So this is a second way of doing it. So this is 100 over 4, which is the same thing as saying what? This is 25,000. 25,000. So what it means here is that average annual profit, average annual profit will be, we have 45. So I will say 45 minus 25 plus another 45 minus 25 plus 40, 40 minus 25 plus 25 minus 25. Okay, so this is the annual profit. How many years are we taking? This is 4 years profit. Then we are dividing it by 4. So what it means now here is that this is now 20. This is now 20. This is 15. And this is 0. All divided by 4. 20 plus 20, 40 plus 15 is 55,000 divided by 4, which will give me what? 55,000. 55,000 divided by 4, that gives me 13,750. So this is 13,750. Now that we know what our annual profit is, then we'll now check our average investment. Our average investment is simply beginning investment plus ending investment divided by 2. So the beginning investment, we invested 120,000. We also invested something else again. We also invested working capital 15,000. We invested it at the beginning too. Then at the end, we had 20,000. So you cannot say divided by 3 because these two are invested in the beginning. So this is like 155. This is 120 plus 20 plus 15, which is like 155 divided by 2, 155,000. Now divided by 2, that will give you 77,500. So that's 77,500. So now coming back to what we want to do, your ARR should give you 13,750. Just to be sure, that is what we had here. Yes, divided by 77,500 divided by 77,500 times 100%. Now we will not say versus. You don't need to put this, but if I were you, I would just bring this 15%, which is the minimum. I'll just put it somewhere 15%. So versus 15%. Somebody is asking a question. Let me see what the question is. Somebody said I should explain AAP, ARR. We are going to explain after I finish calculating. So what we'll do here is we will say 13,750 divided by 77,500 multiplied by 100, multiplied by 100. So that gives me 17.48 17.74. So that is going to give me 17.74% as against 15%. So this is giving us a higher percentage, and this should be accepted. So let's see what ICANN study pack is telling us here. Oh, they did it a different way. Okay, this is the investment. All right, let's do it their way. So let me revise my doing, and they got 16.2. Let me revise my doings here. So I will say this is the investment in plant and machinery. Let me do it the way it's suggested here. This is 20,000. So what it means here is this is the actual investment in plants and machinery. You bring the beginning and you bring the end. So this 120 plus 20 is 140. 140 divided by 2 is 70, right? 140 over 2 is 70. Now, this divide did not go under here. Plus the 15,000. So this is 70 here plus 15, giving you 85. That should be 85 according to theirs. Yes, 85. So that should give you 85,000. So now, why is it smaller? Why is the rate smaller? This is because in the denominator, when your denominator is bigger and your numerator is remaining stagnant, your answers will be smaller. But if your denominator is getting smaller, your numerator is stagnant, your answer will be bigger. Okay, so now let's do it again. This is 85,000. So I just want it to agree with what our book is saying. 17,500, 13,750, sorry. 13,750 divided by 85,100. So that gives you 16.18. 16.18. I want to use it to two decimal place. 16.18. Let me use it to two decimal place. I like it that way. 16.18%. It is still bigger than the 15%. We can still call it, sorry, is it 16.18? 16.18, yes. So here they say it's 16.2. Don't see how it is 16.2. From our calculation here, except we did a different thing, it is 16.18. So it's still fine. So you see here now, from this, you will say accept project. This is based on financial basis only. All right. So based on financial grounds, we should accept. All right. So we've done that of the ARR. Now let's look at advantages. It is easy to understand, and it uses concepts that are familiar to business managers, such as profit and capital employed, easy to calculate. Then there are disadvantages. It is based on accounting profits and not cash flow. Profit is not cash. Somebody could have profits but no cash. Accounting profits are also unreliable, and it also ignores timing of the accounting profit Still seeing questions? Still seeing questions? I will answer your question. I will answer it. Let me just talk about the advantages and disadvantages. I'll just skip through it. It's going to um, doesn't use account time value of money, and like we said, like we saw before, when we look at ROI, somebody could be making big ROI, but when it comes to the actual money, like in residual income, somebody could be making 10 million naira as returns, right? But the returns on investment might be 14%. Another person might be making just 10,000 naira every month, and the returns on the investment might be 16. And you are now saying reject the one of 10 million, which is 14%, but accept the 10,000. So it's unreliable. So now, the person who said I should explain ARR, I'll use this same question. I wanted to use exercise one question to answer it, but we'll look at it. This is the formula: accounting rate of return. Accounting rate of return. We'll take the accounting profits. This is profit before interest and tax. So this is the profit before tax divided by average investment. Now, we now decided that let's deal with the average accounting profit. What is average? Average is add all the profit that was given to you, divide it by the number of observations. So in this our question, we have 4 years that was given to us. And so it means we are going to divide by 4, right? So that's it. Now, we were not given straight the profit we are given. We were not given profit before interest and tax. We were given profit before depreciation. We are told here that this profit is before depreciation. Normally, the hierarchy of calculation is when you calculate your profit, your operating profit, you get profit before depreciation, interest, and tax. We call it profit before DIT. Profit before DIT. So this is what they gave us. Now, it is now left for you to remove the depreciation, because they said this is profit before depreciation. You need to remove the depreciation so that it become profit before ET. We call it PET, but this one is PD. The other one is what they give us here is profit. This is profit before depreciation, interest, and tax. PDIT. You need to remove depreciation so that it will become profit before interest and tax, so it will become PIT. It is the PIT that you are looking for, which we will now find the average. All right. So we'll now decide to find what is the depreciation. Our depreciation is initial investment or initial value minus the final value divided by the useful life. Initially, it was 20,000, 120,000. Final one was 20. You minus it gives you 100. The useful life is 4 years. So 100 divided by 4 is 25. So it means that every year 25,000 is going out from your depreciation, meaning here that 45,000 is the profit before depreciation, interest, and tax. When you remove depreciation, it becomes PIT. So 45 minus 25 is what I did here for this particular year. Second one is the same thing. This is the third year. So you see here, this is straight line method. So it means this is 20, the PTI is 20, the PTI is 20, the PTI is 15, and the PTI is 0. Now, because we are looking for average annual profit, so we are looking for average PIT. This is our PIT. Average PIT is over 4. Now, this is different from the depreciation, which we use the 4 years lifespan to get 25. That one is this 4. This 4 here is because we have 4 years profit. This one we say, this other one is because the asset is spending 4 years in its lifespan. This one here, the 4 years profit is what we are dealing with. We want to make average, and that is what we did, and we make it 13,750. Now that we have our numerator, we now want to go to denominator. They said average investment. Average investment, we invested this in the beginning 120, at the ending we invested, it became 20. So 120 plus 20 becomes 140. 140 divided by 2, that gives you how much? 70. So because this one was depreciating in nature, that's why it's like that. Now this one is not depreciating in nature. This 15,000 is the same 15,000 in the beginning to same became the 15,000 at the end. So this is for the assets, this is for the working capitals. We add the two of them together. This is 70, this is 15, becomes 85. And that's what we did here. 13,750 over 85,000 gives us 16.18. Accept the project. So I want to believe that this is clear for the person who is asking that question. The person asking that question, please confirm that this is clear. Okay. Once I get a confirmation, I will now go to the second part of the I will now do the second one so that we can go to the next appraisal method. So please, can you confirm if it is clear? Okay, so it is clear. Very good. So let's go to practice question and see how we can practice the more. Now, the reason why I'm doing some of this practice question is you might not know some of this practice question might come out in the exam. All right, so practice question 1. A capital project would involve the purchase of an item of equipment costing 240. The equipment will have a useful life of 6 years and will generate cash flows of 66,000 each year for the first 3 years and 42,000 each year for the final 3 years. The scrap value of the equipment is expected to be 24,000 after 6 years. An additional investment of 40,000 in working capital will be required. The business currently achieves a return on capital employed as measured from the data in its financial statement of 10%. Now, required. Calculate the ARR of the project using the initial cost of the investment to calculate the capital employed. 2. Calculate the ARR of the project using the average cost of the equipment to calculate capital employed. 3. Suggest whether or not the project should be undertaken on the basis of its expected ARR. So we have 3 questions in one. So now let's see what was given to us here. So we see practice question 1. So this is, uh-oh. This is practice question 1. What is happening to me? Sorry, something is controlling my pen, so it's making it crooked. Okay, so this is practice question 1. All right, so let's look at what they ask us to do. We'll state the formula here. ARR. We say it is going to be average annual profit, annual profit all over initial, I'll put a bracket, or average investment. So you see, either we use initial or use average investment, whichever the question is telling us, times 100%. Okay, so let's start with the average annual profit. We say average annual profit. Now, in this question here, we are not told if this profit is before depreciation, but it's fine. We assume it's before depreciation as before. So they said the profit will be how many years? Um, 66 for the first 3 years, 42 for the final 3 years. But before we do the profit, we need to first of all do the depreciation. I'll start with depreciation. Annual depreciation. Depreciation. The asset was bought for how much? 240, and the scrap value is 24. Okay, 240 scrap value 24,000 divided by 6 years. And that will give us how much? Let's bring our calculator now. 240 minus 24, that's 216, divided by 6 years. That gives us 36,000 as depreciation. This is 36,000. Okay? Now, I want to do it in another way. Now, your average annual profit is simply, for the first 3 years, you are going to be making 66,000 naira every year. So I will say this is 66,000 multiplied by 3 years. That's for the first 3 years. Then for the second year, for the third 3 years, from year 4 to year 6, it's going to be 42,000. So this is going to be 42,000 multiplied by 3 years. Of course, like we did in the first one, every year there will be depreciation, right? Every year there will be depreciation. So I will just simply say minus the accumulated depreciation for the 6 years is going to be 36,000 times 6 years. So this is the depreciation that is going away from each of the profits. Of course, 36,000 for the first year, 36,000 in the second year, 36,000 in the third year. I could as well have said 66 minus 36 in bracket multiplied by 3. Then I could have as well said 42 minus 36, put them in bracket multiplied by 3. But to make it simple, for the first 3 years is 66. This is without the depreciation. For the second part of the 3 years, this is the income or profit without the depreciation. Now look at all the depreciation that is going to be removed. That's why I put them here. Now because we are saying it's average, we'll divide everything here by 6 years. Okay, so this is like an alternative method from what I did. I was doing them every year, but I can't be doing them, assuming it is 10 years. I can't be doing this minus this every year like that. Now this is going to be how much? This is going to be 66 times 3, which is 198. So I'll say this is 198,000 plus, and I will say 42 times 3, that's 126,000. And I will say this is 36 times 6. That's 216. 216. Okay, do everything here divided by 6. What would our final answer be? We already have 216 here. Let me just put a minus before it. Then I will come and say plus 198 plus 126. Of course, this is 108,000. This is 108,000, right? Now let's divide it by 6. That gives us 18,000. So what it means is that for every year, annually, this is the annual returns on an average. This is the annual profits or returns that we are getting every year. So this is what we are going to use. Then let's go to our investments. Investments, we are told to use initial, which is going to be how much? 240. Then we will now add this 40,000 naira in working capital. We'll now add the 40,000. In everything you do, add your 40,000 in working capital. So this becomes 280,000. Okay, so this is what we are going to use in the first one. So in the second one, which is called average investment, we will say 240 plus 24 divided by 2 plus 40. So let's get them down out here. So let's say this is 240 plus 24, that's 264 divided by 2. That gives you 132. Then you now add 40 to it. Gives you 172. 172. 172. Sorry, I made a mistake here. Instead of 280, I wrote 28. So this is 280 This is 172. So the first one here is the A part. ARR is simply what we have here is 18,000 divided by 280 multiplied by 100%. What would that give you? So I'll just simply say 18 divided by 280 multiplied by 100. That gives you 6.43. 6.43%. As against what? What was the current 10%? As against 10%. So we are making returns using the first initial. In the question it says initial is the first one, initial cost. Second one is average. Now in the case of average, because it is getting smaller, it's going to be bigger than 6. So now look at the second one now. B, your ARR is still going to be 18,000 divided by 172. So what would that be? I will just twist it a little. The other one was 280 and this one was 172. I'll just twist it a little. I'll multiply by 280 and I'll divide by 172. So that's fine. This is 10.47. This is 10.47. For those who are thinking, how did I do it? Use your calculator. You will get the same thing I did. So it's high time we go advanced. So now the question here is saying, suggest whether or not the project should be undertaken on the basis of expected ARR. You say for C, reject ARR using initial cost. Accept ARR using average cost. Now, can you see how unreliable this is? If you're using initial cost, it gives you a different thing, gives you a different advice. Use another thing, it gives you another advice. So you see one of the disadvantages, but at least you know how to calculate ARR. Now let's go to the next one. The next one here will be the payback period. What is the definition of a payback period? It is the length of time before the cash invested in a project will be recovered from the net cash returns from the investment. It means that you made a capital investment, capital expenditure. You want to recover this capital expenditure from your operational income. How much time will it take you to pay it back? Suppose that a project involves capital expenditure of 80,000 and the annual net cash returns is 30,000 naira each year for 5 years. What are we going to do? It means that if you are going to be getting 30,000 naira every year for 5 years, how many years will it take you to return the money back. You simply say the initial money, which is 80,000, put it at the top. The annual amount you are getting every year, you put it below, and it gives you the number of years. So what it means here is that your payback period, I call it PBR or payback period. PBP is the same thing as um, initial investment, initial investment over annual cash. I will say net annual cash. Now, what is the decision rule? What will make you want to use payback period? Now, using the payback period, a maximum accepted payback period is decided as a matter of policy. A maximum accepted payback. So it means that the company will choose that we our payback period should not be more than so and so year. Maybe not be more than 5 years, not be more than 3 years. If the expected payback is lower than the maximum limit, and the project is accepted. But if it is higher than the maximum accepted period, then the project is not accepted. Now, in this case, this ignores the time value of money. So now let's look at this payback period. Should the project be undertaken? A company requires all projects. So let's say this is example 2. A company, let's write our example 2 here, which is payback period. So we say this is example 2. Example 2, payback period. Okay, so what's the question here? It says a company requires all investment projects to pay back their initial investment within 3 years. So this is a maximum. It is considering a project requiring capital outlay of 140 on plant and equipment and an investment of 20,000 in working capital. The project is expected to earn the following cash receipts: 40, 50, 90, and 20. So now they are not, this is not annual, they are not equal. They are not equal. So we cannot use, we will not use, what do they call it? Um, Average annual. Okay, I look at what I will say, 140. I will say investment 140 plus 20, which is 160. Now I will say year um, amount residual. Let me do it this way. So this is year 0. This is 160. I'll put it in bracket because that is outflow. So it's still remaining 160. In year 1, you brought in 40. You brought in 40. 160 minus 40, you'll be left with 120. In year 2, you brought in 50. You brought in 50. you'll be left with 70. Then in year 3, you brought in how many? 90. You brought in 90 and you have a positive of 20. It means that you settle it within, you settle this within 3 years. So what it means here is that you have this 70 that is remaining. So you say 70 over 90. So let's see how long it take you. 70 divided by 90, okay, times 12. So it take you like 9 months. So this is like 2 years plus 9 months to complete. Let's see what ICANN has it, and should the project be undertaken? Yes. So let's see. The same thing I did. So they call it cumulative cash position at the end of the year. Anyhow you put it, it's not a problem. So this is 20. I didn't complete it, so there will be no need for me to complete. So this is my cash flow. 20. My cash flow will now be say 25 plus 20. So where is it? 25 plus 20? Okay, 25 plus 20. Okay, 140 plus 20. That is 160. Let me see what they did here. 160 divided by 4, that's 40. I don't see any reason why I'm seeing 25 plus 20, which is 45. Okay, this is 25. Okay, 20. This is 20 here. I don't see any reason for this analysis here. But what it's here saying here is this gives me 2.78, which is 2 years, 9 months. We said we did 70 over 90. That gave us that 0.78. When I multiplied it by 12, it's what gave me the 9 months. So it's going to be undertaken because it is the payback occurs in the 3rd year. So it's going to be undertaken. So that's the essence of this. What are the advantages of payback? Simple. The method analyzes cash flow and not profits. Cash flow. Now there is a difference between cash flow and profit. In the case of profit, we need to remove depreciation, right? In the case of cash flow, depreciation does not involve cash flowing out, but profit does not even involve cash. That's why we could remove depreciation from profit. But when we say cash flow, cash that came in the beginning and cash that went out. This is real cash flow, so depreciation does not come in. So it doesn't involve accounting profit. And this is better than ARR. Sometimes payback is often used with discounted cash flow because sometimes you will not ignore cash value of money. Disadvantages here, it ignores cash flow. after the payback period. So you can understand why I didn't calculate after the third year. All the cash flow are ignored. Okay. It also ignores the timing of cash. Now, what we mean by timing of cash is this. Now, see that third year, I can decide to pay back all the money on the ninth month. I didn't pay anything in the first month. I didn't pay anything in the second month. I didn't pay anything in the third month. I can decide not to pay anything in the first month, pay anything in the second month, and pay everything in the third month. It ignores the timing of cash. Okay? So do well to listen to remember them. Now, let's look at this practice question. A company must choose between two investments, project A and project B. It cannot undertake both investments. Now, I want you to listen carefully. When they say a company cannot undertake two investments at the same time, that means they are mutually exclusive. Mutually exclusive. It cannot be the same time. For example, they say parallel lines does not meet. They are exclusive. Day and night cannot occur at the same time. These are mutually exclusive. You cannot be a man and a woman at the same time. Although some people are trying to change their gender, but these are exclusive, mutually exclusive. All right. So you must choose one. Now, the expected cash flow for each project is given to us here. Now, the company has a policy that the maximum permissible payback period for an investment is 3 years. And if it has a choice to be made between these two projects, the project with the earlier payback will be chosen. Calculate payback period for each project, assuming that cash flow occurs at that year at assume that cash flows occur at that year end, assuming that cash flow after year one occur at a constant rate throughout the year. Okay, so let's see. They have brought a technical thing in it. Okay, now look at how much is the initial investment. Is the same thing, 80,000, 80,000. So let's look at practice question 2. Practice question 2. So now this is year. Okay, let me just say Y arrow. So this is project A. This is project B. I almost say project fail. Okay, it's not project fail. This is year 0, 80,000. This is 80,000. Now at the end of year 1, that is when they are paying this 20,000. And this person is paying 60,000. So this is 20,000. How much will still be remaining? It will still remaining 60,000. This person is paying 60,000 at the end of year 1. It will now be remaining 20,000. At the end of year 2, this person is paying 36. This person is paying 24. At the end of year 2, this person is paying 36. This person is paying 24. So here 4,000 is done here. And how much is remaining here? This should be 24 remaining. Then this is year 3. In year 3, this person is paying 36. This person is paying 2. This person is paying 36 here. And so it will remain 20. 24 was remaining now. You took away 36. That should remain 16 and 12. 12 is a positive cash flow. And here you have 2,000. You have 2,000 and it became 6,000. At the end of year 3, this person is making 12,000. At the end, this person is making 36. This one is also taking 17. And this one is making, at the end of year 4, this person is taking 17. So that should be like how much now? 17 plus 12, that is 29 here. This person is dash is 6,000 that is still remaining. So which will you undertake in this case if everything is coming at the end of the year? So at the end of year 3, because year 3 is a cutoff date, both of them were able to meet. But you see here, this one was able to meet up in year 2. This one was able to meet up in year 2, right? But this one also did meet up its year 3. But if it were you, after this project being completed and it meets the company's deadline, look at the cash flow, 6,000 at the end of year 3, and this one having 12,000 at the end of year 3. I would rather choose project A, even though, but if you are looking at it from the basis that, because they said here, the project with the earlier payback will be chosen. The earlier payback here is project B. But as a sensible person here, I will choose project A. Now, looking at it in the second example, we'll see what I can still solve to see their own. In the second example, when we say on the basis of constant periods throughout the year. So now, here, this person did it in 1 year plus 20,000 divided by 24 multiplied by 12. So let's see, 20,000 divided by 24 times 12. That gives you 10 months. So this person used 1 year plus 10 months. Why this person use 2 years plus 24 over 36 times 12. So let's see, 24 divided by 36 times 12. That gives me 8 months. 2 years, 8 months. So this person used 2 years plus 8 months. So Let's see. Are the project acceptable according to the payback rule? Yes, both of them. Which should be selected? I said I will be selecting project A. Do you agree with this? With that, this is the most appropriate decision, investment decision? I say yes. So let's see what they did. Oh, they have done chapter review. Let's see. Let's see what they did here. 1 year, 10 months, 2 years, 8 months. Yes. Okay. Both meet the policy requirements. Project B would be the preferred choice, which pays more quickly. Yes, based on the two criteria, um, project A, project B will be able to pay back in good time, better than project A. But they are looking at it now from the aspect of time it will require to pay back. Now, can you see now? I was thinking on my own, based on my own personal feeling as a businessman, that looking at 12,000 versus 6,000, I want to take this 12,000 or even 29,000 as residual. But you see here, payback does not look at it. Payback just look at it doesn't look at the cash flows after you have paid back. Payback is just looking at the time it will take you to pay back. That's all. And so it takes me 1 year, 10 months to pay this, it takes me 2 years, 8 months. Both of them meet the criteria, but I'm choosing B because of the quicker payback. So can you now see the flaw in now using payback? Because it doesn't take consideration the cash flow after, just the time. I just did that to demonstrate to you that that is what payback is reasoning. So you should not reason that, oh, I'm having 29 after. No. What is the shortest payback period? That is what you should go for. So far, so good. We have looked at two investment appraisal method, which is payback period and accounting rate of return. These are important um, um, these are important investment appraisal technique that you should know because it might also be tested in the exam. In our next class, we'll be looking at the discounted cash flow. We're talking more about the MPV, the IRR. Both of them will be our center of focus. Then we will now look at a question that will warrant us. So let's check that question out. We'll be looking at question here. Let's see the question: investment decision, NRR, and we'll be looking at this. We'll be looking at this. We might not look at all of them. We'll just look at the best possible one, and you do the remaining one as an assignment. Looking at what again? Those two are question number one questions. So we look at one of them to help us to understand um, that particular topic. So it's important for you to know an exam question that may want to test that may come with number A, use accounting rate of return. Number B, use payback period. Number C, use NPV. Number 4, IRR. In just one question. It could be in question number one question. And so you need to know how to use all of them. So thank you so much for the time spent in with me here in investment appraisal. So our next class is going to be on discounted cash flow. So come prepared for that class as we will have an enjoyable time with you. Until then, I'd like to say my goodbyes now. Thank you so much and see you in the next class. Okay, somebody was asking a question. Where did we get 2K and 6K from project B? Wow, where did I get the 2K and 6? Okay, look at project B. We have 80,000 that was spent in the beginning. When we now got a cash flow of 60, we have recovered 60 out of the 80. It means that 20 is still remaining to be recovered. We brought 24, according to the question. We brought 24 and we have recovered 20 out of it. So 4 is remaining. And I need to go back to the question. We've brought 24, and this is a 2K I brought here, and that brought 6,000. 2 plus 4 remaining 6,000. But it appears that this 2K was not looked at because this is the 24,000 that was used to complete this 20,000. It stops here. And so that's, we are looking at 4,000. But if I look at all the cash flow, it means 80 was the outgoing, 60 was incoming, 424 was incoming, 2 was incoming. So this is the 2K plus the 4K that we have excess, making it 6K excess with us. I believe this clarifies your understanding. So we are going to be taking the discounted cash flow in our next class. So I'll leave it here so that it will be opening to this page the next time we open this. So thank you so much. Keep your questions coming in the WhatsApp group and I will be glad to answer you. Thank you so much.